So just a standard disclaimer, nothing that you hear in this entire video is investment advice. Everything is for educational purposes. Please consult your financial advisors for any investment advice. If you like the content that you see today, please like the videos, share and subscribe, share it with your friends. For a more detailed disclaimer, please use the link in the description of the video. Okay, so there are 4 asset classes basically, right? Fixed deposit, real estate, gold, and then stocks or mutual funds, which we basically call as equities. Now, each of these asset classes have their pluses and minuses. So for fixed deposits, the biggest advantage is that it will not fall, right? You don't end up losing money, blowing up money in most cases, 99.9% of the cases. But the flip side is it doesn't grow more than inflation. So over the long term, like 5, 10, 15 years, it's a sure shot way of losing money. Because what is the fundamental reason why people save and invest? The reason is that they want to beat inflation. So if you are purchasing one mango today at 100 rupees, of course inflation is going to make that mango cost 200 rupees say after 10 years, right? So when you save today, you want that 100 to go to more than 200 so that at least you can afford 2 mangoes 10 years later with the same money that you invested 10 years back. About real estate, the great part about real estate is a big store of value. So big chunk, because real estate is not cheap, like 5,000, it doesn't come at 5,000, 10,000. Minimum investment is 50 lakhs, 1 crore, 2 crore, 5 crore, sometimes even 25 crores, right? It's a big store of value. Once you invest in real estate, you don't think of selling it very easily, very fast. So you don't end up spending that money. However, the returns over long periods, there are always good times, there are not so good times. Like between 2021 and today, real estate has given great returns. However, between 2012 and 2021, real estate had almost given probably less than 2-3% returns, right? So over the long term, more or less, the returns that we get from real estate are around inflation, except for those parcels of land which, where development happened, some highway came, which was outside city limits, but now today is inside city limits. These kind of arbitrage or these kind of exceptional opportunities only give big returns in real estate. Otherwise, if you buy a flat in Dadar or Worli or wherever in Greater Kailash in Delhi or whichever, good places in good cities, the returns will probably be near inflation. When it comes to gold, see, gold has given phenomenal returns in the last 2-3 years, right? In fact, last 1 year has been amazing. My opinion about gold is a little more conventional probably, and it's very different. I don't think it's an investment class. I think gold jewelry has to be enjoyed by the ladies of the family. Buy as much as they want, but buy jewelry. Don't buy paper gold. I don't think it's much use. I don't think it's an investment product. So we have to go a little back in history, right? So between 1945 and 1971, the price of gold, right, was exactly $35 per ounce. So after the Second World War, the entire world came together and said that we will price the US dollar against the price of US dollar against gold will be $35 per ounce. Every other currency will have a certain price around gold, around USD, right? So gold was the reference. So for almost 26, 27 years, the gold price went nowhere, zero. So that was not an investment. So now the world abandoned the gold standard. That's why the price went up. We have to also see what the price of gold over the history has been in USD, not just in INR. So in INR, the returns are much better because of depreciation of the currency. But if you look at gold returns in USD, they are not that great. Now that brings us to the last asset class, which has the only way to beat inflation, right? Which is stocks or mutual funds. And why is it an asset class which can beat inflation? It's because you are banking on human ingenuity and human enterprise to make money, right? What is the way to make money in stocks? You buy a good company, the management, the employees, the CEO, and the top management, the owner, work very hard to make the company grow. So there are lots of examples of companies which have grown a lot over 10, 20, 30, 40-year period. And because they are the best in their field and in their domain, they have grown much more than the average company. That is why stock investing will give you phenomenal upside. What is the problem with equity as an asset class? That's the only asset class where the value will actually go down. So if you don't, so two reasons: if you make mistakes, you will end up losing money. And if you have a short-term vision, there is a good likelihood that you will end up losing money in the short term. So that's the downside with stocks. Each philosophy of investing works. Like momentum investing works, value investing works, buying options works, selling options works, futures trading works, short-term investing works. Each philosophy works, but at a different time period. No philosophy works on each time period. So if you are following, say, growth investing, doesn't mean every year you will make money. There will be periods where growth investing will give you negative returns. There are periods where momentum investing will give you negative returns. There are periods where options trading will give you negative returns, right? So no, every philosophy works. However, at the same time, each philosophy does not work all the time. So there are times when the philosophy will work, do very well. There are times when that philosophy will do very poorly. The second part we have to realize is what are the base rates of success. What do I mean by that? So if you take 100 traders, right, options traders, and if you analyze their last 3-year, 5-year, 7-year profits, SEBI has actually done this multiple times and has come out with public reports with very detailed analysis of lakhs of investors who have done options trading. What they have found is that only 7% of the futures and options traders actually end up making money more than the FD interest, which means there is a 93% failure rate of making money, not of individual trades. On aggregate, they have made less money than FD. So they were much better off not spending a single minute, just do a 3-year FD or a 5-year FD and you will beat your performance that you have spent hours every day into trying to trade, right? Similarly, if you look at momentum investing works wonders over long periods. There are lots of studies which have shown that momentum investing works extremely well. But the flip side is that in the years that it doesn't work, the drawdown or the loss is huge, humongous. So it's difficult to stick to that philosophy when the losses are huge. Sometimes, like in 2009, momentum investing strategies actually ended up losing 80 to 90% of their previous peak, right? So what is that? If you actually observe around, if you look, so this is a field where the older you get, the wiser you get and the richer you get, right? So if you look around, which are those old, wise, rich men or women, right? So, or those investors. So those rich old investors, most of their money has actually been made by long-term fundamental investing, which means the base rate of success for long-term fundamental investing is the best. So that is what I follow. There is one more reason why this suits my personality. This suits my way of investing. I like to read books, I like to read annual reports, I like to think, and I like to act only sometimes. I don't want constant action, which means this long-term fundamental investing works very well for me. That's why I follow it. Now, let me elaborate on how this actually works, right? So, GDP, interest rates, war, tariff wars, politics, who is the prime minister, what is the economic policy of the government, of the country, all these things, of course, have an impact on the stock prices, right? But they have a short-term impact on the stock prices. There is a saying which says that stock markets are a voting machine in the short run and a weighing machine in the long run. What it means is that over a 5, 7, 10-year period, if the profits of the company go up, stock price will go up. If the profits of the company don't go up, stock price will not go up, right? Classic example, and there are several examples like this, I'll give. In 2006, Pidilite, which is Fevicol, was one of the best adhesives company in India. There was consensus that it is one of the best way back in 2006 itself. Even today, it's considered one of the best, the best adhesives company in India, right? Even though there is more competition today. In these 20 years, the profits of the company has gone up 25 times and the stock price has actually gone up 60 times, right? So this is how successful investing works. You identify the correct company, uh, make your thesis, buy at low valuations, keep checking whether the company is on track, hold till the company is on track, don't be in a hurry to sell, let the management and the employees do the hard work. You do the hard work of being patient and not being fickle with your investments. uh, 2 3 aspects to this. Okay, first is it's very difficult for us to understand the importance of compound interest. So we all of us know the formula, right? But we don't realize the magnitude of compound interest when it starts creating magic in the 10th, 12th, 14th, 15th, 20th year. Because if I actually tell you, you have to remain invested for 20 years, it looks like a joke. I'll probably be really old and or I would have lost all my hair. I've already lost half of my hair, right? And you would also probably, your kids will be on their own and your life will be very different. So investing for 15 years, 20 years looks like a very long period, some different universe altogether, right? But that is where the magic of compounding starts. And we have to sow the seeds today. It's like growing a big banyan tree. Nothing is going to happen in 2 years, 3 years, 4 years, 5 years, right? But if you don't plant the tree, if you don't water it, if you don't cut the weeds around the tree, if you don't nurture the tree, nothing is going to happen in the 10th, 12th, 15th year. So the benefits, the big chunk of benefits is only going to come then. So one is, we underestimate the power of compounding. Our minds are not wired to understand the big benefits that we get later. That is number one. Number two, our mind always underestimates or overestimates things, right? So it's difficult to estimate success. So the success will always be much greater than what we would have imagined. For example, HDFC Bank, right? You take the example of HDFC Bank. And now there was a lot of consensus way back in the 90s itself that HDFC Bank is a great institution, right? And there is this company which was like a co-promoter for this company called NatWest. So NatWest was a financial institution in the UK. So NatWest, if I'm right, if it held around 26% or so of the HDFC Bank. But once HDFC Bank came out with an IPO and there was a 97 Asian currency crisis, then there was a 2000 tech bubble burst and a lot of problems for this company. They thought that this is some small company in an emerging country. It doesn't add much to the overall picture. They ended up selling their entire stake. If they had held on to that stake, that stake would have been like way bigger, much bigger. Today. So somebody who was sitting in 96, 97, 98, 2001, he or she just couldn't imagine what the size of HDFC Bank will be in 2025. So the other reason why this long-term investing works wonders is that we tend to underestimate the success, right? That's how it is. So there is a saying by, I think, Peter Thiel, right? Peter Thiel had mentioned this, that most times, so what he basically mentioned was, if an early investor in a startup is also investing again in a subsequent round at say 10x the price or 20x the price of the initial price that they paid, don't think that they are doing a foolish thing and getting carried away. It's because now they realize what the upside will be for this startup. And there are several examples where the early investors actually ended up investing again at 10x, 20x, and the company actually became much, much bigger. So that is another reason that optimism works, and then nothing like success, and we end up underestimating the success of certain companies. What is the single biggest reason why people will sell out, right? It's because once the stock price goes down, they don't know whether they have made a mistake or not, because the stock price might have gone down maybe because the market conditions are bad, or there is a problem with the company, or there is an error in the stock selection, right? There could also be periods where the company has done badly in the last 1 or 2 years. So I put it this way: it's like life. Any company is like a living organism. There are good times, there are bad times. Bad times don't necessarily mean the entire future is bad. So of course, there is a big death rate for companies because of capitalism and competition, but some good companies survive and they come out stronger. As an example, thousands of companies went bankrupt in 2001 after the tech burst. Amazon stock price actually went down by some 98 or 99%. But from that previous peak, today the Amazon stock price is much, much bigger. The company is much, much, much better, right? So if I just come back to revise, when the stock price has gone down, the normal investor doesn't know whether it's the market, it's something wrong with the company, something wrong with his investment philosophy or his investment selection, something wrong with his advisor. He doesn't know, right? So when we say partner of the business, so what we need to do is there are cycles. So the other part is there are cycles in the market. So there are times of optimism, bull market. There are times in bear markets, right? So in bull markets we have to be cautious. In bear markets we have to be optimistic and buyers. So if the problem is that you bought high at a bull market, but the company is really good and the company is doing well, then there is no need to be afraid when the stock price has gone down. So what Warren Buffett, Charlie Munger have said is that in your investing journey of 50, 60, 70 years, if you can't digest a 50% reduction in your portfolio at least 2 to 3 times in your entire investing lifetime, then you are not fit to be a stock investor. What does it mean, right? This is inevitably going to happen. You cannot prevent it. Something will happen somewhere, some trigger will come and the stock market will go down. All companies will go down, even good companies' stock prices will go down, and you have to digest it. When can you digest it? There are 2-3 things. If your study is well, you have a good advisor, you have confidence in the investment process, you have enough knowledge about the companies that you have invested in, or you have enough trust in your investment advisor, right? And you also have a reasonably conservative portfolio. What it means is that you don't have 100% in small cap volatile stocks, right? If you have that 100% of your net worth and you are retired, you don't have any other source of income and you have 100% in small cap stocks, then that's a recipe for disaster, because markets will test you at their worst. So if you can survive the worst, then you can also enjoy the good times. If you can't survive the worst, you will get thrown out. It's like a train which is going ahead. If you can't handle the speed or the the jerks, you will get thrown out. The train will go ahead. Typically, we start working at say 22 and retire by say 62, right? Or say 60. So about 35 to 40 years is what we'll be working. Sometimes a few less, a little more. So we need a plan for our entire life, investment plan. So don't look at 1 year, 2 years, right? We need a system which works for 40, 50, 60 years, right? So that's the true long term. Doesn't mean we have to hold every stock for 40 years, right? But we need a system of investing, a process of investing which will last well for a long period of time. I would say, on more practical terms, more than 5 years is long enough. Longer the better. But 5 years is a long enough time to figure out whether what you are doing is correct or not. See, the other problem of investing is that there is no immediate feedback. It doesn't mean that if you took a good decision, you will suddenly in the next 1 month you will make a lot of money, and if you take a bad decision, then in the next 1 month you will lose a lot of money, right? What decisions you took 2 years, 3 years, 4 years, 5 years, 7 years back, you start realizing whether they were good or bad today. So what decisions you are taking today, you will only realize 5 years, 7 years, 10 years later whether they were the correct decisions or not. That's the problem of investing per se. That's why we also say invest for the long term, because then at that time you will know exactly what went wrong and how to course correct. Second, it's pure mathematics. See, Indian GDP is growing by 7% on an average for the last 30-35 years. Inflation is approximately 4 to 5%, which means in nominal GDP terms, India is growing at 12%, which means the Indian GDP is doubling every 6 years, right? Is the classic rule of 72. So since Indian GDP is doubling every 6 years, even if you enter the market at the wrong time, provided you are in the correct stock, entire GDP is doubling, your companies will also benefit. So if you invest for a long period of time, the chances that you will end up losing money or doing badly on your investments dramatically reduces. So there are enough studies which show that over a 10-year period, there is almost a 0% chance that you will end up losing money in stocks or Nifty index or some of these products or mutual funds, for example. So in mutual funds, discipline and consistency works, which means save every month, invest every month. Long-term investing works, which means being patient, irrespective of markets ups and downs. Invest over a 5, 10, 15, 20-year period and let the compound interest start benefiting you, right? The names of the actual mutual funds, in my opinion, doesn't matter too much, except that you should be invested in large and diversified popular mutual funds. Don't go for thematic, fad of the day, new fund offers and all that. Just invest in diversified, popular, which everybody knows are good mutual funds, right? Diversified mutual funds. The trick is compound interest over the long term and consistency of saving every month, every day. Now, why do I recommend investing in mutual funds, right? Even though I myself probably have about 80-90% of my net worth in stocks, and I am a stock advisor, right? The single biggest factor which will throw you off your investment journey is volatility. It's just too difficult to handle that, your portfolio was say 100 6 months back and today it is 70. Right? It just messes up with the brain. Whatever we tell ourselves long term, this I can digest volatility, I can do this, I can do that. I don't mind this. I just want to make sure that after 10 years, that 100 rupees becomes 1,000. I don't mind in the interim if 100 becomes 50. It doesn't work. Most 99.9% of us will start having problems and it will impair our judgment, including me. So what happens is, mutual funds are an excellent way to cut down the volatility. If the market falls 10%, mutual funds will fall 10%. Stocks may fall 25%, right? So having at least say 50% of your wealth in mutual funds makes sure that you can take more unconventional decisions in your stock portfolio. Why do I say that? I call this as a barbell strategy. What is a barbell? So this, like, when you go to the gym, there is weight on the left side, there is weight on the right side, the bar is like really light, right? What means is diversified, simple mutual funds, invest every month, don't look at market levels, don't look here, there, take 2 or 3 maximum mutual funds, just keep investing every month, right? Simple strategy, low cost fees, low maintenance, right? It's very important. You just don't have to think, you just keep investing. On the other hand, you look at exceptional opportunities where, can I catch on to an HDFC Bank early? Or can I catch on to a Asian Paints early? Or something like that, where I can make phenomenal returns. So these mutual funds will lend stability to your portfolio so that you can try unconventional strategies in your stock portfolio and try to make more money. Now, why do I say that? Let me also come to the reality. 90% of fund managers like me underperform the index over the long term, right? That's the reality. It's very difficult to beat the markets. The way to beat the markets is to be unconventional. Only buy when you feel that there is exceptional opportunity available. At most of other times, just keep reading, just keep understanding businesses. Don't buy, don't sell. Look for those 2 or 3 great opportunities every year or every 2 years. See, we have to look at extremes in the stocks. If you want average performance, mutual funds is the best way to do it, right? They are a great product, very stabilized regulatory regime, low maintenance. You don't have to bother about much. You don't have to bother about what is getting bought, what is not getting bought. In stocks, you have to look at extreme opportunities, wait for those opportunities and then buy. As I said, 90% of the active fund managers actually end up losing money. So if you want to do a satisfying job in stocks, it's not going to work over the long term. You will end up being those 90% of the fund managers which will not make money. A few successes can pay for a lot of mistakes in your stock portfolio. So for example, if you have a 10 stock portfolio, right? Let me explain this part. So if you have 100 rupees and you invest 10 rupees each in 10 stocks, right? and you were a bad stock selector, or rather, you were a little unlucky, or whatever you call it, and 9 of those companies failed, went bankrupt, right? But one company did very well, and over a 10-year period, it went up 100 times, which means that 10 rupees became 1,000. 9 companies failed, which means you lost 90% of it. 90 rupees you lost. So starting value 100, after 10 years, ending portfolio value is 1,000. This 10-year return is 26% CAGR, which is compared to FD return of say 6-7% today, right? Amazing returns, right? But what is the success rate? 10%. Failure rate 90%. You were 90% of the stocks that you picked actually were bad decisions. This is the only place where, in spite of having just 10% marks, the overall outcome can be great or phenomenal, right? Provided you look at these opportunities. So this is a very important concept, and it doesn't come intuitively, and one has to intellectually understand this. See, suppose my returns expectation are say 15% CAGR, which means I want, say, every 5 years I want the money to double, right? That is my initial expectation from a stock portfolio, for example, right? So what will happen? Will the money grow 100, 115, 135, 155, 180, 200 every year? It doesn't happen that way. Most likely what is going to happen is 0, 0, 0, 0, 4 years 0 returns, 5th year direct double. So at the end of 5 years, 100 became 200, but for those first 4 years, you are scratching your head, what is happening? Am I with the right advisor? Am I with the correct stocks? Am I doing the right thing in life? What is happening? Or the opposite could happen, right? In the first year itself, portfolio will double. So 100 becomes 200. But the next 4 years could be 0, 0, 0. So at the end of 5 years, the outcome is respectable. So doubling your money 5 years is a very respectable outcome, right? But the returns will always be non-linear. So they will never be smoothened out. They will always be up, down, up, down. So most likely 15%, minus 20%, 50%, minus 10%, 20%. This is what, most likely the return profile will look like. We as long-term investors, we have to be conscious of this. The only thing in our hands is that when the markets goes down, or there is uncertainty in the environment, and when the prices are lower, when there is pessimism all around us, that is when we have to be buyers. We have to buy at that time. So the way to make money in there is a simple formula to win in the stock markets: buy good businesses at low valuations and hold for the long term. So low valuations will only come when there is uncertainty around you. There is some sort of pessimism or some genuine problem in the macro environment. So let me first tell you what the macro environment is set up as, right? See, India is the only young and fast growing economy in the entire world. China has already seen a huge economic growth. Now their populations have started decreasing. The second thing is that there is a big trade war between US and communist China. And the rules and regulations are such that investments in China look a little difficult to do, right? Plus their best time has probably been behind. They will of course continue to do well for a long time in the future, but the pace of growth and change will probably not be that high. What makes money for the investor is not where you start and where you end, right? The pace of change, pace of improvement is what you make money. US is again a mature economy. It's the best economy in the world. It will continue to be the best economy in the world for a long time. But again, the pace of change is probably not going to be very high. Europe is old and non-growing, right? So the only bright spot today is young India. Second, we have to appreciate that each country has gone through a phase of demographic dividend. What it means is that the number of people in the working age population is maximum and young and educated. So England went through this phase in 1800s, US went through this phase in I believe up to 1950, 1960. Japan went through this phase in 1960, 70. Japan and Singapore. South Korea went through 80, 90s. China went through 90s, 2000s, 2010s, right? So every economy which went through this demographic dividend has done phenomenally well in the 20, 30, 40 year span. That is where we are positioned. So this is what India is for you. Definitely a certain portion of your investments has to be allocated to India because the pace of growth is going to outpace everybody else. The second part is, I think everybody is worried about currency depreciation. When if you look at the last 40-year history, currency has depreciated for India. But what is happening today? So let me take 2 minutes to see what is happening, right? See, with all this, so first thing that has happened is that India has always been a big energy importer, right? And that used to always weigh heavy on our current account deficits. And consequently, all the other factors like currency reserves and all that stuff, right? Today, IT exports from India are larger than oil imports, right? And IT exports are growing faster than oil imports. So the fundamental structure of the Indian economy has changed in the last, say, 7 or 8 years. And chances of India facing trouble on the external currency front have dramatically reduced. What other things have changed, right? India has moved on to what is called as inflation targetary monetary framework since 2015. What it means is that central bank is focused on maintaining inflation. The biggest reason for currency depreciation over the last 40 years was a different inflation rate in US, different inflation rate in India. So inflation was, say, 2% in US, but it was 8, 9, 10, 11% in India. If you analyze the last 10 years, inflation is actually reduced structurally in India. It's now 4%, right? So the differential between US interest rates and Indian interest rates has structurally changed. If you look at today, home loan is available at 7.5% in India. It's probably available at 6.5% in the US. So the differential is, which was 6% before, is today just probably at 1.5%, 2%. If we also look at what is today happening with the trade wars with the US, right? There is a parallel with 1971. So what happened in 1971? I'll quickly take 2 minutes to explain. So after 1945 World War II, the world came out with what is called as the Bretton Woods system for currencies, which means that the US set a price to gold of $35 per ounce, right? So 1 ounce of gold is worth $35, and every other currency, major currency like Japanese currency, pound, and German mark, all those currencies were tied to the US at a fixed rate. This helped a post-war boom, free trade, and a lot of economic development. Europe did well, Japan did well, US did well, right? But by 1971, what ended up happening was inflation was going higher in the US, unemployment was rising, and so US had promised that anybody who comes with dollars to their central bank, they will give back gold in lieu of dollar, right? So there was a guarantee that whenever, if you say take these dollars and give me those gold at $35 per ounce, the US central bank will honor it. But the amount of dollars which were in circulation outside US was $40 billion, whereas the actual physical gold present with the central banks in 1971 was only $10 billion, right? And then Nixon came out with this, what is popularly known as the Camp David meeting between 13th August and 15th August 1971. And one big decision that they took at that time, because they were worried about the dollar, is that they abandoned what is called as the gold standard. So from tomorrow, no longer we will exchange our dollar for gold. What this was an indirect way of saying that please appreciate your currencies versus the dollar. You export too much to us, we export too less to you. This is an unsustainable trade balance, and this gold standard will no longer hold. So instead of saying that tomorrow, instead of price of gold being $35, it will be $55, what they ended up saying is we will not give you gold in lieu of dollars. Indirectly, what ended up happening was dollar depreciated, the other currencies appreciated. If you also look, and they also imposed a 10% import tariff on all other countries, so that these countries come to the negotiating table and a new normal is established, right? This is exactly what is happening today. US is imposing tariffs on every other country and telling them, please start producing in the US. You export much more to us than what we export to you. This is an indirect way of actually saying that we want to depreciate the dollar and we want your currencies to get appreciated, right? If you also look at 1985 Plaza Accord between Germany, Japan, and US, so the big decision at the Plaza Accord was, the Japanese yen will appreciate against the dollar, right? So they again depreciated the dollar. In my opinion, sometime in the next 2 to 3 years, that is exactly what is going to happen with the US dollar. 2 years, 3 years down the line, I think dollar will be at a much lower value compared to most of the other currencies. So the thought, in our conscious mind over the last 30, 40 years is that every year dollar will keep, rupee will keep depreciating and dollar will keep appreciating. 3 to 5 years down the line, I don't think, this statement is going to hold true. In fact, there will be a very hard reset of maybe, 20, 30, 40, 50% of dollar depreciation in the next few years. So to summarize, somebody who is outside India and looking to invest in India, A, you are getting a high growth economy with the best years ahead for us. And B, I don't think currency depreciation is any longer a big issue over the next 5 to 10 years.